I'm going to show you an amazing order flow entry strategy. That too, we're talking about the level 2 liquidity order flow based. Here, we are going to give you the perfect way to enter when there is a very good volatility, when there's a very good momentum in the market. I have here the recent chart. It's yes. This is the example from this week. I'm going to show you 3 days, last 3 days. I'm going to show you how I was able to pick these exact entries when the momentum is going downwards in this case, because we are not going to randomly assume few things. We are going to pinpoint the reason behind it, why we're entering. Looking at the order flow, I'm going to walk you through what I see, how I find the entries, how I'm going to confirm it, and then how I'm also giving you in 2 simple rules. That's just 2 simple rules that you can follow, and then you can make the same trade entries. In this example, you're going to learn how I'm able to find this entry to make the same thing, almost $3,000 trade. Same thing, the momentum is going downwards. This entry, how this is, if you are not going to look at the level 2, this one is middle of the range. Most of them will miss this entry. Most of them again miss those entries. I'm going to show you why these 4 entries had a most highest conviction by looking at the order flow. Level 2 gave me the very good confirmation, and that's why I'm able to enter. And also I'm going to show you the same chart for a couple of more days. This is 130. I'm going to show you same thing, how I was able to, market was going sideways here, okay, that's why, but there is a momentum. How I was able to know this is where the market is going to go from here. It will not go much below. Also the same direction I was able to find. I'm going to show you the reason and then entry, the rule I followed for these 2 entries as well. One more chart. Let's look at 27th. We had this particular day, we had a very good momentum in the morning, and then market went sideways. But when the market opened, the market went low here. Why this particular low was the lowest it can go with high probability? I will show you the reason why, what I saw in the liquidity, what I saw in the level 2, what I saw in the order flow. That helped me to identify this particular place where I took the long. Again, the same thing where I took the second long, and then when the market reversed, why I took the short here. I'm going to walk you through everything based on order flow with 2 simple rules to follow. Before that, this is Rob from BuySide Global. If this video is going to help you learn something new, please make sure follow the channel, subscribe, and then like the video. So let's get started. Here, everything I'm going to show you is based on level 2. What do I mean level 2? Let me show you the screen, what indicator I'm using, what product I'm using. This is BSG liquidity zones. What the lines you see here is from level 2 order flow, the market depth. There's a lot of products in the market. It's going to paint all the order flow on the screen like Bookmap. So Bookmap is the market depth visualization tool where it converts all the level 2 numbers and data into the visual way. It paints everything. But I had a hard time finding the perfect entries with those tools because it paints everything. So we created something not to paint all the order flow data. We want to create some algorithm sits in between to reduce all those noises, all those spoofs, all those non-institutional liquidity, so that we can see only the strongest liquidity on the chart. That's why we created basic liquidity zones. Again, we're going to use basic liquidity zones, and also we're going to use some fundamentals of the market structure, also the momentum. But when I say momentum, what do I mean momentum? Rule number 1, do not trade against a momentum. What do I mean by that? Let's say the market is trending down like this. Do not try to find the short. The goal is when the market having a down momentum, you are going to find out the entry for shorts. The shorts, like we will help you to find exact shorts where you can take the trade to down, right? At the same time, if you have the market is trending up, something like the market is going up, you should be able to find how to find the long entries. We will help you to find the perfect long entries, something like this, where you should be able to grab the entries, take the trade all the way to the until the momentum is over. But what you should not do is, when the market is going downwards, this strategy that I'm going to teach you is not going to help you to find the reversals. Do not try to trade against the momentum. So rule number one is, don't trade against the momentum. When the market is down, this strategy is not going to help you to find the reversals. It's going to help you to perfect entry to trade with the momentum. Same thing this way. Do not try to find the shorts here, right? But you can ask me, what about the market sideways? Will this strategy work? Yes, it does. If the market is going sideways, still this strategy is going to help you to find the trades, to find the entry here, to take it into the range, to find the perfect entries to take into the range. It goes both ways, because sometimes even the market, you will be able to find the perfect places where you can find the shorts to go into the range. So the rule is, do not trade against momentum. If the market is going sideways, it's okay to find both ways, long from the bottom of the edge of the range or the top of the range. You should be able to find the trade entries short to take into the range. Both works, but do not trade against momentum. That's a rule number one. Number two is the order flow rule, meaning, how many times you heard, oh, that look like there's a support. This is where we priced, when the price, like something like when the price going sideways, how do we say there is a supply and demand? A lot of people will look at, okay, this is the price where like a lot of prices bounce. This is where there's a lot of support. That means we can take long from here, right? That is a supply and demand rule. Same way it goes to on the top side, when the market is like bounce multiple times, bounce 1, bounce 2, bounce 3. They say this is where the supply, this is where the resistance. You can take short side. But one thing is, this is assumption based. This is why the system don't work. Just because the price turned before, you are assuming next time it's going to turn. Just because happened even one time, twice, thrice, four times, doesn't matter. Because it happened in the past, you are assuming next time it's going to bounce, so you're going to take the shot. What happens? The market run it through, take your stop, you exit your trade. How many times it happened to you? For me, it happened so many times. That's why the supply and demand, or a market profile or volume profile, everything is assuming, oh, there's a lot of support, there's a lot of demand, price is going to move up or move down. So that doesn't work at all. That's the beauty is, we have level 2 right now. Level 2 help change the game completely. What do I mean by that? By looking at level 2, using the BSG liquidity zones, you can do one thing which is we cannot do with any other strategy or any other tool, which is, you can buy when the institutions are buying, you can sell when the institutions are selling. Why? The algorithm that we developed is helping to show you the most important is institutional quality order flow. Okay, so keep in mind, I'm going to show you how to buy when the institutions are buying, so that you can be in the same direction of the trade. Also, you should be able to enter exactly or near somewhere where they are buying. So that's the key. Let me show you both in those cases. All right, so let's go back to the chart right here. This is BSG liquidity zones ES from this week. This green is the strongest bids, strongest ask from the level 2. Why we are not painting all the lines? We are painting only some of the lines. But one thing is, we are trying to show you, remove all the noises to show you only the tradable liquidity. Market open, you can see the market going sideways, right? Market going sideways. You can see a lot of sellers right here. There are a lot of buyers right here. Anytime the price goes into that range of where the lot of highest volume of bids are there, price goes and reject immediately back into the range. This is what we are going to use. Meaning, if there is a price grows into the liquidity, this is liquidity, like a lot of bids, into the liquidity, immediately rejects. That's what looking for. That means when the market is um consolidating, right? If you see a line that starts printing buyers liquidity coming up right there, if the price goes into that range and then bounce immediately as soon as it touches that particular liquidity, what it means is the strength of the buying order from institution is so strong. Once the price comes to that level, the buying kicks in, they are able to fill the order, and then they are able to add more buy orders. It's pushing up. That's what it is. That's what we're going to look for. Same thing what we're going to do anytime the price moves up, and then we are coming down. If you see something like same thing, if you see like the strongest liquidity is there, something like already building up very huge quantity, what are you going to do when the price come back to that level, touch that particular thing and then reverse immediately, immediate rejection, something like you touch the static electric current, how fast you take your hands off, you feel some kind of reaction. Price, once it touches, it pull back immediately. Why? Once the price touches, it triggers the limit orders, and then it brings up a lot more buy orders into the market that pushes the price up. That's what we're looking for. So the same way, opposite side is also true. When there is a momentum, when there is a momentum in the market down, let me use a different color. When there is a momentum in the market down, if you see the liquidity, something like it starts to build something like this, you need to wait till how the price moves. Something like price moves down there, it goes up. As soon as it touches, it's come back down. This is what we're going to use as we saw the strongest red line. Price went there, went to the liquidity. As soon as the price touches the strongest ask, level 2 ask, prices immediately triggered the sell orders is coming down. That's what we're going to look for. So in that context, I want to take a look at this particular chart right here. Look at this one. Remember what we talked about? When the prices come back down, touches the liquidity, immediately it bounces back, and then what happens? Price goes back again. One more chance. So because this is what I showed you in the example. Look at this one. Look at this. When the prices went back, pulling back the strong liquidity right there. Once it touches, it moves back. This is what we're looking for. Once you see this particular reaction, you should be able to take a small bet. Meaning we are day traders. We don't want it to trade anywhere and then put a stop loss very far. Trade with the largest stop loss. If you see this kind of reaction, you can enter right here, put your stop loss right here. Very small bet you can take that can help you to take a long run. Anytime you see this kind of reaction, you should be able to trade with entry after the reaction. Place your stop behind this level. Okay. Like I said, there will be liquidity on both sides. Why I told you it won't work if you try to trade the opposite side. Look at this. The momentum is upside, right? You can see higher high, higher low. You can see the liquidity sweep here. We're looking for when the momentum is upside, we're looking for liquidity sweeps on the bottom side, on the pullback side, because there will also be liquidity sweeps on the top side. You should really ignore. Don't even think about it. Because look at this. Because when the market is moving up, it's going to eat a lot of liquidity anyway. You should not even try to trade those things. When the market momentum is going up, try to look for the liquidity sweep rejection on the opposite side. Market up, look below, look on the pullback. That's what we're looking for, right? So if you are with me, then look at this. Market is higher highs, higher lows. Market starts coming down, right? But look at what happened. Like I said, when the market is coming back up, you see strong liquidity. You can see immediately it's pushing it back. This is the third opportunity to take the short trade. We can take it right there. This is what exactly we showed you just before a few minutes. Where is it? Let me show you again. Remember this? This is exactly what I showed you to find the liquidity right here, long, short. Because why? Let me go back to the same chart again. This is where we took it. So right here, this long, and then this long, and the moment we saw this liquidity sweep, we took it down, right? So let's look at the next one. Remember that I showed you how we are able to trade entry here long, take it right here. Let me show you the same thing in the BLG liquidity zones right here. So if it same way, if you look at it, the market is going sideways. Remember I told you just a few minutes back, when the market is going sideways also, if there is a liquidity, strong bias liquidity starts building, right? When the price goes down to the liquidity and then see immediate rejection, you can take the long. That's exactly what's happening right here. Do you see this? There was a strong bias liquidity. Price went back. Once it touches, it's pushing back immediately. You can see the huge wick. That's a rejection right there. That's when I took the long here. So this is what is the other entry I showed you? Look at this. Look at this particular institutional buying. The green line started printing. The price came. It didn't even touch it. You see that it didn't even. It came very close and bounced it. But next time it took the liquidity. It ate all the liquidity and then immediately. It didn't even go much below. See that it immediately rejected. Look what happened. Look what happened. This is why we're looking for either market sideways. Look for the strong liquidity. Particularly price need to bounce. That's a key. A lot of traders, our new customers, make this one mistake. Just because the liquidity is there, they will take as soon as the price comes near it. No, don't do that. The reason is sometimes the price momentum is so strong it continues goes down. You need to see the little bit uptick, the little bit of reversal, little bit of rejection, little bit of bounce, little bit of retest. That is very important, because that's the retest, the bounce, the rejection is the proof the order flow, level 2 order flow, the bids is stronger than the momentum. Do you get what I'm saying? You need to see the proof. If you don't see the rejection, the price keeps going down. What it means? The momentum, the market orders momentum, market orders coming into the exchange momentum is more stronger than the bids sitting in that location right now. So whichever is greater is going to win the market, right? That's the key. We need to know whichever is greater is going to win the market. That means you need to see, wait until the price, once it touches, it should reject. Immediately, it should not be able to pass the gate. It should not be able to pass the gate. Buyers should be stepping in, putting on the gas pedal, pushing the buying bids very strongly. It should push the price back up. You should wait till the bounce. Once you see the price liquidity was swept, what do you mean by swept? It's a good question to ask. Price, there's a lot of bids. Let's say 100, 200 bids there. Once the price touches, what will happen to the bids? It will be consumed, it will be disappearing. That's what you see this. Once it came down, it's gone. But look at here, it came back down, with the bid still continues. Here, it came back down, it ate the liquidity, sweeping the liquidity sweep, and then rejecting. So practice this. This one strategy is going to help you to change your trade entry when there's a momentum in the market. We had great momentum whole last week, including Fridays. Fridays generally is a sloppy day, but last Friday was an amazing day. Why? Do you want to see why? Let me show you. Let me show you what happened on Friday. This is Friday, guys. This is our Friday, 1:30, January 30th, Friday. We had the market was going sideways little bit early in the morning. See this? I'm sorry. Little bit going sideways in the morning, little bit. But see this? But moment it was going sideways, remember I told you something about when the market was going sideways, you can look for the short on the top, long on the bottom going into the range. Let me show you how we can find out. And also, I'm going to show you how I'm able to find this entry to take it to carry whole momentum down for the $3,000 trade. And this entry, this is middle of the range. How did I take the short here? And then why did I take short here? Why did I take short? The same rules. Remember the same rules we talked about? You should see the strong liquidity. Price should go to the liquidity, eat the liquidity, sweep the liquidity, immediate rejection, and then you should be able to take the trade. Now, let me show you the same thing with the liquidity based liquidity zones indicator. the same chart. This time you should be able to find yourself. I don't even need to help you. Look at this one. Okay, look at this one. The beauty is, look at this. When the market was consolidating little bit, right? But look at this. Remember I told you, remember that few minutes back I just mentioned something. When the market is going even for sideways, you can, if you find a liquidity here, and then the price came back here, sweep the liquidity and then reject immediately, you can take a long into the range. At the same time, I also mentioned, if there is a liquidity up here, if the price goes to the liquidity, eats the liquidity, reject immediately back into the range, you can take a shot. Now, keeping that in mind, what do you see here? What do you see here? Do you see this? Do you see this? It's a range. It's a range, right? It's a range. But do you see this price went into the liquidity, immediately rejected there? You can take the shot until here. But also look what happened here. What do you see here? There's a liquidity here. Price went to the liquidity, immediately gasped into the range. And then what happened? Went into the, look at this. Look at this. Now the bigger liquidity, that's there since morning. This one came just last minute, right? This one came the morning. All day it was there. Price went back, took the liquidity, immediate rejection. This is the golden entry for you to take the way down. All right. So this is why our first trade was here. Moment I saw the liquidity was swept, rejected immediately on the strongest liquidity from the morning, that's a greatest entry. Okay. Where was second entry? Look at that. Price pull back down and then went into the liquidity, immediate, didn't even go above, immediate rejection. So this is a second entry. Goes back down, pulling back up and going up. Look at that. There's another liquidity is there. Once the price took the liquidity out, rejection again. This is the most effective trades you can, again, look at this. Look at this. If this is something you cannot practice in a couple of weeks and then start trading, I don't think there will be any other strategy. Here's the biggest difference between anything that you have, supply and demand or volume profile, anything. There is no way for you to confirm immediately this is the price level. I can exit, I can put the stop right here. If I'm taking the short, I can put the stop right here because you took this liquidity, it rejected already. If it goes above it, the trade already failed. So you don't need to keep your stop way up. You just need to keep it here. All the strategies that you're trading, supply and demand or like a volume profile or a wave up, you are going to trade based on assumptions. Oh, there's a support because I saw a couple of bounces. It's going to reverse. That's assumption. There's a difference between assumption-based trading, proof-based trading. The proof is here. We are looking at the real-time order flow liquidity data. And then once the liquidity was swept or liquidity started pushing down, we are taking the trade. That's why liquidity trade is much more powerful than any other trading. 1, 2, 3, 4. This is what I showed you before. Look at this. Remember that I told you, I told you don't take the opposite side, but it always also the same way. Right? Went to the lowest liquidity, sweeping, go to the top liquidity, sweeping, come there, sweep this liquidity, go back up, sweep this liquidity, come back down, sweep this liquidity, go back up, come back down, sweep this liquidity. Market goes between the liquidity. You need to know 3 things. Okay, I showed you 2 rules, different things. But if you want to master things, you need to know how to read the level 2, how to read the market structure, how to read the momentum. That's all it is. Everything simple. Hope this video helps. If this video helps, if you want to see more video like this to help you to find the perfect entry, perfect stop, perfect exit, how to find the momentum, how to find the choppiness, how to find the range, subscribe to the video, subscribe to the channel, and then please like the video, comment below whether you hate it or like it. Put your comments below. Those comments and likes and shares is going to help us with the algorithm to grow a channel. Thank you so much. You have a wonderful day.